They say every brand has a story, and that was part of our story. Good morning, ladies and gentlemen, and welcome to this, our third National PKF Zoom post-budget event. I'm here at the ICC in front of some 400 people, and on Zoom at the last count, some 1,656 people had registered. This is one of the biggest international PKF events. I will entertain you for about an hour or so. I'll give you some general information, but I'm certainly not giving you any formal tax advice. That is in a PKF office with one of the PKF partners or tax partners that you deal with, and obviously at the requisite fee. There's some 39,000 tax guides in production and in distribution. 37 different companies make use of our content. So if you see a tax guide that has a different cover and you open it, in all probability, it is a PKF tax guide. Today, I will do the presentation, but in the background on Zoom, there will be partners from our various offices answering the questions in the question and answer box of Zoom. Some of those questions might very well be put to me at the end of the presentation, depending on how easy or difficult those questions are. I have a threshold, not too difficult a question is allowed to be asked to me. In particular, I want to highlight Mohammed Mayat from our Octagon Johannesburg office. Yesterday, he was in Parliament representing PKF, and he was responsible for the summary of the tax matters that was issued late yesterday afternoon. I also want to highlight Kubashni Mudli, my fellow tax partner in Durban, who spends hours with me on the content of the tax guide. It is an onerous responsibility when we sign off that content to make sure that there are no errors, and I certainly value that contribution. I also must make reference to Rao Kelly, our IT partner, and Keshan Reddy, our IT manager. All of these IT things seem to go smoothly, but they don't really. And I really thank them for the efforts that they've spent to make sure that this goes as smoothly as it ought. So I start with the State of the Nation address, the 30th since our democratic era. And I got this from Frank Solutions, where he said, solutions only need action. And unfortunately, there was no action in the State of the Nation address. There were admissions of the millions of rands that have been squandered, stolen, wasted, wasteful expenditure and corruption. There was admission of the millions of our youth who have no education, no employment, and no hope. It was, unfortunately, still the greatest comedy event of Cape Town, even without the EFF. We all know the cost of load shedding, and unfortunately, our government has no real solutions. Every time one of them says we are at the end, we are merely at the beginning of the end, as Monty Python would say. We go to worse stages when we ought to be getting better. And there were easy mechanisms to resolve this. How can our retailers and our manufacturers truly operate with 290 days last year under load shedding? We all thought that President Ramaphosa was going to lead us out of those wasted years. But in truth, he was part of those wasted years, and unemployment has continued to increase under his leadership, and we've all got poorer in terms of our GDP per capita. The most scary thing is that since the dawn of democracy, when 2.5 million people were given a grant to sustain them, we now have some 27.3 million people on a grant system. 44% of the population is unsustainable on a grant, and we need to have economic growth if we are going to get anywhere. Our first Deputy Minister of Finance, Alec Irwin, who was an economics lecturer here in Durban, said if our country could only just sustain growth of 4% every year, we, one, would not need BEE because the natural growth of the economy would force integration, and two, we would make meaningful reductions in the levels of unemployment. But our focus has been wrong and our growth is negligible. We still have a stormy year ahead. Phala is not going away. SARS is looking at what they call a fake dollar declaration. So maybe there were dollars, maybe there weren't dollars, maybe there is a couch and maybe there isn't a couch. The Russian-Ukraine war is still waging, and that will have continued impacts on the cost of our grain, the cost of our soya, and the cost of our fertilizer. We saw the municipal coalitions not working, and in all probability after the 29th of May, after the election, we will have more coalitions at a provincial and maybe even a national level. The Middle East war, and in particular the Houthis and the shipping routes, are going to put up the cost of imported goods. Our ports already cannot cope with the shipping, and yet more ships will need to come past the Cape of Good Hope, as it was. We all have an important right to vote. In some countries, that right is enforceable by a penalty, and in others, it's enforceable with jail or a fine. We must remember the importance of that right. And throughout this next 12 months, there are 65 elections taking place all over the world. The world is a changing place. Democracy has that effect. And if we look back to the year 2000 in America, when Gore and Bush went head to head, 537 votes in a country of some 300 million people determined who was the next president of these United States. If we look at the people that are registered to vote, a lot of the youth are not registered to vote. Your vote can make a difference. I hope that none of you are part of the largest party in South Africa, the I did not register to vote party. And I hope that none of you will be members of that second largest party, I registered but I failed to vote. Your vote will make a difference. The budget process starts with the midterm budget. And in October 2023, we heard about our debt spiraling. We heard that the interest that we were paying is more than what we spend on the police, or on education, or on health. And in this budget, the minister reconfirmed that. He was desperate then for SARS to collect money. Every rand SARS collected, he said, was one less rand he was required to borrow, because he could not focus on the reality that he actually had to cut expenditure. SARS tax collections are down 56 billion, according to the budget yesterday. We are going to have a bumpy end of February and a very bumpy March. The commissioner will want to show that the minister was wrong with this projection. And he is going to do everything in his power to collect before the end of March. It's going to be a tough period. In 2021, we first heard of the national insurance coming through. We said it wouldn't work. We wanted a funding model, and we still do not have a clear funding model. But as part of the electioneering of SONA, all the president could say is, where is my pen? I want to sign this into law. Without a plan, without the doctors being on board, without the ability to actually sustain this. There was a lot in the build-up to the election. What was he going to do to raise the 15 billion he said he needed in October? We now found out in the budget that that 15 billion is really just to fund the debt service cost because of the additional borrowing government had to do because the collections were down. So all of our tax increase is essentially going to pay for debt. There was a worry as to what would happen. Would NHI properly come in and would those rebates come to an end? There was some worry on VAT, but in an election year, really, what did we expect? So we had what's the silent killer of tax, bracket creep. We have no inflation rebate adjustment. We have no medical tax credit adjustment for inflation. So it looks on the face of it that the tax rates have not changed because the top rate remained at 45% and the trust rate remained at 45%. But the reality is that people will get increases. And because of those increases, they will move up a bracket. And whereas historically that increase did not lead to a tax increase, it will now because of bracket creep, because no adjustments were made to the table whatsoever. And so people will be paying more. There was a minor change in the subsistence allowance, possibly because many government officials make use of the subsistence allowance, but that is a win-win for us too. The points that disturbed us the most on budget night when printing our books was that the travel allowance table was not updated and the reimbursement amount was not updated. Our books make reference to the fact that the table was not available, and it still is not available today. Our books are published on the night of the budget. We went to press at about 5:30 in the afternoon, and at that stage, having spoken to senior people in SARS, there was no light at the end of the tunnel. It's a troublesome matter. It happened once before. When the new tables do come out, we'll update them on the web and on our app. The corporate rate of tax did not change, but it couldn't. We began a process of reduction of our corporate rate of tax, and he certainly could not continue with that in the election year, so he was forced to retain it. Our dividends tax remained the same. Our state duty, where I thought there would be a change, remained the same. Transfer duty, the table changed only a few years ago, so it really wasn't ripe for a change. And VAT, it ought to have changed. Unfortunately, politics wins in the end of the day. There was, however, no increase to the general fuel levy, which will put some 4 billion rand back into the economy. As one of my retired partners would say, that was a mistake because it's an easy tax to collect from 5 oil companies, and at least the taxis pay some contribution towards the tax bill. But it does affect us all when the fuel price goes up, and there will be a price increase for a carbon fuel levy at the beginning of April. The sin taxes went up more than inflation, but no other relief, no relief for small business, no relief for business as a whole because of the plastic bag tax going up. They absorb some, they pass it on, we're all going to pay as a consequence. But the one thing I'm now happy about is that there is excise on vaping. It came in June 2023 after much fighting, people saying that vaping was better than cigarettes. But at least there's now an excise there. And there's a limited focus by SARS to try to deal with the illicit trade that flourished under COVID. They're installing CCTV cameras in some of the tobacco warehouses to ensure that there's a control that the duty is paid. And they've recovered some 4 billion rand in illicit trade of gold and tobacco. So there is some progress, but that is not a fun industry to take on. So, Mr. Minister, in your speech, you said there's a crude distinction between economics and politics, and that would be that economics is concerned with expanding the pie and politics is about distributing it. Unfortunately, this budget did nothing to expand the pie, and there's not much more left to distribute. We will have an incentive coming forward in the next year or two for the manufacture of electric cars in South Africa with a very healthy allowance on new investment. But in reality, who is going to invest? The major car manufacturers have spoken a number of times of pulling out of Durban because of our poor infrastructure and pulling out of Port Elizabeth or Gqeberha because of its poor infrastructure. Are they really going to come and set up some new manufacturing plants? The wheel of the budget process is a slow process. We start in February with the budget speech, and by the end of the year, we get that signed into law. It takes some time. So let's look at what happened last year. The rooftop solar was hailed last year as something that could assist to reduce our reliance on the grid. But we could not get Parliament to extend that. We tried as PKF, I addressed Parliament, other players addressed Parliament too. So there are 7 days left to get somebody to install rooftop solar in your house and to bring it into use with evidence that it is generating solar. Thereafter, that solar rebate is bye-bye. They say in solar that we've doubled our capacity, but that is statistics, damn statistics. When you double zero, you're still at zero. Yes, we have more solar, but not where we ought to be. The important thing, if you are going to act in these last 7 days, is, and I'm told to be politically correct here, one spouse pays or both spouses pay, you have a different benefit. If one spouse pays, you're limited at that 15,000 for the one spouse who paid. If both spouses pay, they will each be entitled to up to the 15,000 rand rebate. So you need to ensure that you do this process properly. There's a lot of planning for 7 more days to go. But businesses, you have another year, and you must act as business because your electricity cost is only going to go up. So why not have some level of solar with this enhanced deduction of 125% to reduce your bill? Now, a business is a business. It's also, if you're renting property, that falls within this. So there are more than just the brick and mortar businesses that we all know, but you need to take advice on when you start broadening that spectrum. But there's the ability for you to do something. So act now. The 2-pot system, which is really a 3-pot system, was going to come in March 2024. National Treasury, buckling under the pressure of the large insurance companies, was going to move it to March 2025. The minister, buckling under the trade union pressure, moved it to 1 September 2024. But that's not the end of the story, unfortunately, because there are now new hearings on the 12th of March about the actual pensions bill itself, and there is going to be further pushback by the large insurance companies. And the reason for this is that when 10% of your current vested pot, or 30,000, the maximum seed capital, is transferred to your savings pot, which you can then take out, government projects that some 5 billion rand will leave the grasp of those insurance companies. And so they are fighting for the control of that money, and the people are fighting for the use of the money. There will be a tax consequence of it. There is still more in the story, but it is evolving, and at present, it looks like it's coming in on 1 September 2024. Section 11G is a brand new section of the Act, and it's to try to codify Practice Note 31, which has really been around since the dawn of democracy, and was to allow you to claim interest paid against interest received when you are not a bank, when you're not carrying on the business of a money lender. The question was, how did they fit this into the Act? Because 11A requires trade. So they're bringing it through a new section 11G with reference to another section which does not require a trade when it's defining interest. And so there's the possibility of this working. It's only coming in January 2025. So the current Practice Note 31 is still applicable for the set-off of interest paid against interest received without creating a loss. However, SARS have commenced far more audit work on this deduction than they've ever had before. Now, a South African trust can distribute to a non-resident taxpayer. In March 2019, they were no longer allowed to distribute a capital gain to a non-resident because a non-resident would not be subject to tax on a capital gain. Now, from 1 March 2024, no further distributions will be allowed to a non-resident. They must first be taxed in the trust. So trustees need to, as part of their whole process of ensuring compliance, know the tax status, the tax residency status of the beneficiaries. Now, when you passed away, historically, the income post-death was taxed in the hands of your heirs. But recently, they created a new taxpayer of the estate where this amount was to be taxed. So if you have a non-resident with money in the bank earning interest, that non-resident did not ever pay tax on the interest because they were not resident in the country and they were not here for the requisite days. But the moment that they passed away, that interest became taxable in the hands of the estate because the estate was a resident. The laws changed from 1 March 2023, so the estate's tax residency follows that of the deceased taxpayer. Employers are required to withhold PAYE from their employees, but there was an exemption for foreign employers. But in the last amendments, foreign employers with a resident that aren't resident, but they've got an actual business establishment in South Africa, a permanent establishment in South Africa, are required to withhold PAYE. And that's more than a branch. You actually need to take some proper advice as to whether you fall within that. And that was effective from 22 December 2023. So your December PAYE return is a problem, your January PAYE return is a problem, and very soon your February PAYE return is a problem. We have the speech, and then we have a lot of documentation with the speech. That's called Annexure C, and I'm just highlighting a few things that are on the agenda. There's a possible change to the connected person definition in relation to partnerships. This is going to be an interesting set of amendments and will have an impact. The limitation of interest deductions in reorganizations and acquisitions of business has been under the focus for some time, and there's some tightening up in that regard. You get a rebate for your foreign taxes limited to the South African tax that you would have paid on that income. There's an adjustment already when you have interest income for the exempt portion, but there's no adjustment for the capital gain. So there will be a new adjustment for the capital gain before the rebate is taken into account. And for all the gamblers out there, they're looking at adding some VAT in the gaming industry on the table games. How they will collect all that, we're not sure. But it's interesting if you're a gambler. Now, I thought that this was going to change in the budget. I thought that the interspousal bequest was going to be taken away. There's always one. But it wasn't. And it's something you must be careful about and plan. You must ensure that if your estate is well more than 10 or 15 million, that you are doing some splitting now while you can to ensure that both spouses have a sizable level of an estate in case that interspousal bequest falls away. We plan with the basis of trusts generally, but not all people like trusts. So there are other methods to use other than trusts for those who do not want to use trust. We're going back to technology of the 1970s and the 1980s, but it's worth pursuing because of the impact of Section 7C. The corporate rate of tax came down. So February 2024, we're at the 27% rate of tax. So that affects majority of taxpayers. So there will be a deferred tax adjustment. Just putting it out there, it has an impact on your audit fees. They have to do these very complicated adjustments for deferred tax. So just putting it out there. Assessed losses are limited now, and we need to take care of this when doing provisional tax estimates. So if you have an assessed loss that's greater than R1 million, you'll be limited to 80% of your taxable income prior to that assessed loss. It will have an impact on provisional tax, and as it has an impact on provisional tax for that type of taxpayer, if you get it wrong, it's going to lead to a penalty. The budget proposals indicate that there might be some adjustment for those companies going into liquidation. Lifestyle audits are on the increase, with SARS looking at the credits in one's bank accounts. One must be careful what one deposits. Your great-grandfather and grandfather treated cash as cash. The new generation thought that they could have two bank accounts, one being the equivalent of cash and one not. That is not how the system works. These lifestyle audits are picking it up. They pick up all the bank accounts that are registered in your name because the information is provided to SARS on a 6-monthly basis. The Common Reporting Standard is going to make sure that we receive information from foreign countries. We have already received this. SARS is just taking time to implement it. We are all calling for an amnesty, but it's not going to happen. We have to be careful with the foreign money. BEPS Pillar 2 looked at multinationals and minimum tax, and we're looking to implement this. I'm not sure how many multinationals with over 750 million euros turnover actually operate in South Africa, but we'll see. Transfer pricing is becoming more and more important as our businesses are going cross-border. There are restrictions, there are limitations, there are times when you must make disclosure. This is specialist type advice, and we are able to assist you in doing the benchmarking, in doing the transfer pricing documentation. But what is probably going to be the leading case in the royalty portion of transfer pricing is a non-tax case. It's the Vodacom, please call me, David and Goliath. And here the court, Supreme Court of Appeal, has said that the royalty should be between 5 and 7.5% as being a fair and equitable royalty. So now we know what an arm's length royalty should be. Ceasing of tax residence is a complex process. It's a time-consuming process. It affects you when you have left the country with no intention to return. It affects you if you are living in a country with a home, with your family, with your whole new life in that country, even if you have not done all the formalities. There are processes to follow, and there are capital gain consequences of ceasing to be a resident. When you cease to be a resident, you want this lovely letter, the notice that you are non-resident. Your ties with South Africa are broken, and they will talk to you no more from SARS. But unfortunately, to get there, you go through many, many hoops with much information being requested of you. So many years ago, nobody worried about ceasing of residency because their employment income was exempt. But now it's only partially exempt. So many people are actually in contravention of South African rules because they haven't formally ceased their residency and they're earning income of more than 1.2 million. Section 7C, I just generally call it the interest-free loan, but technically it's either the low interest loan or an interest-free loan where you're below the relevant interest required by SARS. And that's where a planner lends money to a trust or to a company owned substantially by the trust, or subscribes for preference shares in a company that is owned by their trust. There are consequences for this, there are calculations required, and there are submissions required to SARS by the end of March. And because we've had an escalation in the interest rate over the last 12 months, your Section 7C cost will have probably doubled between last year and this year. When you have a trust, you make a choice as the trustees to retain the income or to vest it in a beneficiary. You have always been required to make the date of vesting prior to the 28th or 29th of February of the year. That's not a new rule. The fact that many have never done that doesn't make it a new rule. It's always been there. SARS is asking questions for proof that the decision to vest in the beneficiaries took place prior to the end of February. They're requiring with the tax return an upload of the resolution as such proof. And going forward, in September of this year, unless the divine powers are with the profession, we will all have to make third-party disclosure of the amounts vested in the beneficiary for the year ending 29 February 2024. Which means if you've got a double trust structure from a trading trust to a family trust to a beneficiary, there's pressure to have that trading trust finalized soonest so that the next steps can be done. There's going to be substantial pressure. We as the profession do not have the capacity, although SARS thinks it's as simple as pressing a button. So there will be pushback, but that is what the Gazette says at the moment. We don't know the consequence of non-compliance, but there will be a consequence for non-compliance. If you've got a foreign trust, while the income stays in that foreign trust, there's no tax consequence to the resident beneficiary. But the moment there's a distribution, there is a tax consequence. You then have to work out what is the income that you've actually distributed? When did that arise in the trust? What was its nature? So you have to keep proper financial statements for the foreign trusts with different pots, because if you've got a shareholding of between 10 and 50%, that dividend is going to be treated differently to a dividend of more than 50% or less than 10%. So most of the foreign trustees give you a simple 2-page document or just your share portfolio. More is required to show the necessary proof as to out of which pot that distribution finally is made, and therefore whether it's taxable or not taxable. The doubtful debt allowance is now essentially much easier than it used to be. It's based on the face value of your debtors. If you're a non-IFRS taxpayer, if you're an IFRS taxpayer, it's based on your IFRS calculation. But if you're more than 60 days past due date, so you must have credit terms with your debtors to know whether you pass due date or not, then you get a relatively simple calculation. There's a bit of uncertainty as to whether the VAT is in, whether the VAT is out of the calculation. Let's leave it with the uncertainty. Property developers, they come and go. They want to all make their millions developing property, but then we have interest rate hikes and depressions in the economy, and they're unable to sell their units. There are VAT consequences. There are some temporary relief measures, but there are VAT consequences to the developer in their weakest and most desperate stage. When they can't sell their properties, they have to find some additional money to pay a VAT drawback. You need to be careful as that property developer. This revised assessment used to be issued contemporaneous with a letter from SARS that they had conceded or partially conceded. No longer happening. So you have this vacuum. You have a letter that says you are successful and your tax case has been won, but your assessment remains with a liability. And the moment SARS issues the letter, they withdraw the suspension of payment. And you can't really request a suspension of payment because you no longer have a dispute because you have won. It's something we are trying to deal with SARS, but it does cause problems. It can cause significant aggravation. We have an expensive way to fix it with an application to the High Court, but that needs to warrant a taxpayer with a substantive liability. The Thistle case dealt with trust-to-trust distributions. The main matter, I think that the lower court was wrong and the Supreme Court was right. We'll see it went to the Constitutional Court on the 8th of February. But for me, the most important part of the Thistle case is the whole question of an inadvertent bona fide error. Is the mistake a mistake that you made without the intent of evading tax? Did you take advice before you took the steps that you took? Did you truly believe that you were entitled to the deduction? And here the Supreme Court said that even though Thistle trustees did not have an opinion themselves, within the broad group there was an opinion, and reliance was placed on that opinion, and therefore reasonable care was taken, and if reasonable care is taken, there can be no penalty. Hopefully, this is confirmed in the Constitutional Court, because the next case on a similar set of grounds for the purposes of USP, a completely different matter with regards to the main matter, the coronation case. That case deals with whether you're a permanent business establishment and what you can or cannot subcontract. Very technical, very specific. But here again, we have the case of a taxpayer relying on opinions that were never even provided to SARS, with some so-called big-name firms of accountants assisting them in their returns, but professionals assisting them in their returns. And therefore, the court said that is a bona fide inadvertent error, no penalty. This was heard on Valentine's, and hopefully the Constitutional Court is our Valentine. There are more cases on this inadvertent error because that is where the fight is going to be with SARS. We need to make sure that there are structures in your business to take steps, to take review processes, to ensure that we can argue that reasonable care was taken. What else would one expect from the owner of a company but to have different departments for the VAT returns, somebody checking somebody else's work, somebody agreeing with that process, an internal audit, the auditors being requested specifically to consider certain matters, obviously at a fee in addition to their audit. But this is part of the process to ensure that we can meet the test of reasonable care being taken. In business rescue, everybody wants to have the debt as a pre-business rescue debt. And here the court said the assessment was issued after business rescue, the additional assessment, and so it's a post-business rescue event. The taxpayer argued that tax is due annually and therefore was due at the end of the year and therefore was due prior to business rescue. Now, the late Chief Justice here, Mohammed, who was at that stage an acting judge of appeal in Namibia, because this was pre our new South Africa, his decision in that case said that it only arises as being due and payable upon an assessment. And that was the support that the court found in this case. But in another case, a more recent case in the Gauteng High Court, where somebody tried to stop SARS taking money from them that they had received by way of a loan repayment. At the time of the loan repayment, there was no dispute with SARS. At the time of the loan repayment, there was no debt to SARS. But now SARS argued that the tax arose during the course of the year, and therefore there is a liability at the time that the debt was repaid to the taxpayer, and so they are following the money. Deposits in the bank account, remember the lifestyle audits. Then comes the question, was that a loan? Do you have the proof to substantiate those deposits in your bank account as not being gross income? The taxpayer won in the first court, but unfortunately in the higher court, they were unsuccessful in meeting on a balance of probabilities. On a balance of probabilities is a very broad test, but the taxpayer has to come off as a reliable witness, be able to answer the difficult questions, and in that case, they were unable to do so. In this case, we see once again the power of the opinion. You need to have an opinion from a registered tax practitioner in terms of Section 223 of the Tax Administration Act, where that person, given all of the facts, is going to say that it's more likely than not that the taxpayer will be successful in courts. When you have such an opinion, which comes at a price because it's an insurance policy, then you should be able to meet the test of reasonable care having been taken. There's a long and arduous dispute process. Part of that dispute process was recently changed with an extension of time to lodge the objection. In this round of the budget talks, the process looks like it will change once again, with alternative dispute resolution taking place also at the objection phase as well as at the appeal phase. The concept behind this is that most people really only focus properly on the matter when they're having that interaction with SARS. So we need to all understand the importance of proper response to the letter of findings, proper response to the finalization letter. Our grounds at the objection stage are the grounds that we have to live by or die by as we go through the whole process. We can't just put 4 lines on the form that SARS gives us. We must have a letter supporting the objection. We must have documentation supporting the objection, and we must be prepared to argue the case, just as SARS has to be prepared to argue their case. We are in the grey listing phase of our country's history. It's because we didn't act as fast as we ought to or could have or should have. But we have made a lot of progress this year. You have all been harassed by various officers to ensure that the trustee information is uploaded on the master's portal. This is part of the requirements of the grey listing, and this is part of the requirements of SARS to try to bridge the gap between what the trusts in general earn and what the trusts have said they've distributed to the beneficiaries, because there's a huge hole here. And so when they can find that ultimate beneficiary and correlate the information and have the third-party information uploaded by the trustees, they hope to bridge the gap and generate a lot more money. Similarly, companies are required to give those beneficial owners. You need to ensure that you correctly upload who the beneficial owner is, because having gone through the process, that is what the system is going to show as the beneficial owner. Capital gains tax. You buy or inherit a property many, many years ago. You subsequently make improvements on that property. But the tax event only occurs upon the sale of the property. There's no disclosure to SARS in a formal manner of what you've incurred as improvements over time. You could maybe look to see if you could upload that as part of your return, but at the moment there's no formal process. So it's only at the time of disposal that anybody is interested in what was the cost, when were the repairs or maintenance done, is it repairs and maintenance, is it an improvement, is it something that is part of the base cost of that asset? Only then, many, many years later. And if you have not retained that information, the onus is upon you to show on a balance of probability that the expenditure was incurred. So was there a plan set out? Do you have a contract with some construction company for it? Can you show the bank statements with payments to the construction company? This is going to hurt a lot of people who are then going to sell their homes and make a capital gain greater than the primary residence rebate, and yet they've done improvements, but they have no records. We've seen this in practice already. Home office. A home office is a room specifically used, only used, regularly used as the home office. So now if you have the home office and your children sit next to you and do their homework, that is no longer a home office. If you have a business and your spouse, see, I'm trying to be politically correct, your spouse also has a business, and you both are working side by side in that home office for different businesses, that is no longer a home office. And if you are able to cross all of those hurdles, you must be able to show properly what is the square meterage of the home office and what is the square meterage of the house. So how have you allocated the expenses? And then there's a long and complex practice note issued by SARS where they have different views to us on what is and what is not an allowable expense. But be sure of one thing, you will be subject to an audit, so have the information available before you lodge the return. Provisional tax is just round the corner for the February year ends. We've all had a terrible trading year. Our profits are all down. We must be careful with those estimates because they might not be quite as bad as we're thinking today. If our profit taxable income is greater than $1 million, we must be within 80%. But if our taxable income is less than $1 million, it's even more risky to have a reduction because you must be within 90% of your final taxable income. So beware those who want to reduce the taxable income if your taxable income is less than $1 million. Think about it once, think about it twice, think about it a third time, and then really, please don't do it. Just be very, very careful. The risks are too high because penalties to SARS is money, and they will enforce that. And if you haven't shown that you took the necessary, reasonable, proper care seriously calculating the amount, taking all the relevant factors of foreign exchange, stock loss, sales, all of these things into account, you could have a problem. Section 18A donations, for those who are charitable and give donations, you would have been asked over the last year to provide additional information to those institutions that were issuing the 18A certificate. That was the first phase of SARS getting ready for third-party disclosure. Those entities issuing 18A certificates will need to make disclosure on or before the 31st of May 2024, that's this year, of the 18A certificates that were issued in the 2024 tax year. I don't count it as an error. And if that's the only error in the book, well, then so be it. There's a page where we list these things, and in one time we say on, and in 3 times we say by, and technically it should all be by and not on. But if that is the only error in the book, I can live with it. But it's a reminder for those Section 18A organizations. Your administration needs to improve so that you can make those available, because those will then be pre-populated on the taxpayer, the donor's tax return. And if they're not pre-populated on the donor's tax return, they will have a problem. And if they have a problem, they probably will not donate to you next year. Unemployment is one of the biggest risks we have in this country. We all need to try to do something to reduce it. It's all very well we live in our isolated homes with our high walls, but if we do not do something, there will be a problem inherently for us all. There's a potential of some 10,000 jobs in the mining industry that might be at stake, and so there might be more unemployment. There is the employment tax incentive. If you hire somebody at 4,000 Rand, they're really only going to cost you 1,420 Rand a month. After you take the income tax deduction for their remuneration and after you take the employment tax incentive, every company has a responsibility to try to make use of this to increase our levels of unemployment. But beware. SARS is using this as a focus area because there are some institutions that may or may not meet the definition of an employer in the greatest sense that SARS is looking at it. We hope that SARS will see reason, that these people have been given a job, a purpose in life. That was ultimately the intention of the Tax Incentive Act. So we hope we're going to be able to address those issues. But more importantly for everybody else is the need to do something to create more jobs. Bursaries and scholarships, SARS has not, or National Treasury has not changed the criteria. This is for the missing middle. This is for the people that don't make the government bursaries. They earn too much for that, but not enough to do something for their children. The relatives of your employees to have a happy workforce is where you ought to be focusing on giving bursaries for your BEE points, for the country, for having an educated workforce. There are some criteria. Let's see if we can make use of this going forward. The banks are going to be flooding with you. Have you used your tax-free incentive? Have you invested? Beware that you only invest the 36,000. That's one lot of 36,000. That's not per bank. That's not per investment. That's not duplicating, triplicating. That will cause you a penalty and great pain for the rest of your life with that investment. Beware. Beware also the 500,000 Rand aggregate in your lifetime. But this is important as part of parcel of one's overall investment, but I'm not giving investment advice. Now, trusts own companies, and when the company declares a dividend, it's subject to withholding tax at 20%. There are these fancy little things called dividend trap companies. They're not for everybody. They are for some people. You need to take advice as to whether it is for you or for not for you. But it allows you to have money coming out of your business, which is important because when you sell the business, you will not get full value for your retained income if you leave it all in your business. So it's important to have a dividend policy to take the money out of the business and make the business hungry and fight for its survival. And the money can sit in that dividend trap company and go there without dividends tax because it's a company to company dividend. And it can grow there with investments on the stock exchange. And you can defer and delay the ultimate dividends tax. You need to take advice. You most certainly need to have an opinion to support what you've done. But this is a way to defer and delay, in many cases, the dividend tax. We were part of this binding private ruling. And what it looked like was we said a South African company is owned by a South African trust. But the ultimate beneficial owners, and we did this before this whole grey listing and ultimate beneficial owners, the ultimate beneficial owners are living abroad. They are non-residents. And they're living in a country which has a double taxation agreement with South Africa. So if you do it correctly and have the correct documentation in place, once again, supported by an opinion, you can ensure that you can reduce the level of the dividend withholding tax down to the level in the double taxation agreement, which may be 0, which may be 5%, which may be 10%, which may be 15%, but all of which will be lower than the 20% as if you did nothing. Many years ago, some economists with a sense of humor and a bit of boredom on their hands looked at what's called the Big Mac Index. And they said, what does a Big Mac cost in country A and what does a Big Mac cost in country B? Because really, they should cost the same because you're eating a Big Mac. It's exactly the same thing. And the exchange rate is meant to take into account the purchasing power of one country to another. So a Big Mac in Durban was 51 Rand 90. In New York, it's $5.23. So on the Big Mac index, our exchange rate should be 9 Rand 92 to the dollar, if only. In London, it's £4.99. So we should be 10 Rand 40 to the pound, if only. But if you look at it in dollar-pound terms between each other, the dollar-pound is around £1 is $1.05. And at the current rate this morning, it was $1.26, much closer than the differential between our rand. That's probably because America has got some weird people standing for election, and Britain didn't know whether they wanted to be in or out of the union, and that's causing many problems. But if you look at the rand, our rand is so undervalued. It improved dramatically during the speech. It has the ability to improve. We can all hope and pray. If we pray collectively and together, maybe we can do it. So, Mr. Minister, I wrote on behalf of PKF to the Minister. I sent it to him. I sent it to his personal assistant. I put it on the tips for the Minister as required by National Treasury. And I asked him to protect us from state capture. He didn't. I asked him to instruct the Electricity Minister to instruct the municipalities immediately to ensure that all new houses have solar. He didn't listen. I asked him to make use of chartered accountants in the same way as the previous government did with national service. Chartered accountants worked at SARS for 2 or 3 years. They could work in municipalities. They could return to SARS. They could return to National Treasury. They, like the doctors, could have some form of service back to the community at a proper rate, just like the doctors do. There is the ability to make use of that. He didn't listen. I said he had the power to do more than what he did just with managing the money. He must manage the expenditure. Unfortunately, he hasn't listened. He was too focused on the election. He was too focused on his constituency, and he forgot about South Africa. I thank you all for listening. I do know that there are one or two questions that Kabashni is going to bring up to me. She's got strict instructions. They can't be too difficult, but there will be one or two questions, and these then will be heard not only by you here in Durban, but by everybody on the Zoom as part of the process. So these will be questions that haven't been answered by the other tax partners during the course of the Zoom presentation.
Good morning, everyone. So yes, there has been a few questions, some of which we did try and answer on the online, but I think for the benefit of the audience, we sort of felt that we needed to address it here as well. Okay. And in terms of the tax tables for individuals and them not changing, I know you did speak a bit about the fact that inflation and all of that, but can you maybe just elaborate a bit more on what this means to households across South Africa?
So the broad and general number is that South African households on average earn somewhere in the region of 25 to 30,000 Rand. So it's a number that's very distorted because you've got a lot of unemployed people and you've got a lot of people who are very, very rich. So it's once again a statistical issue. But if we analyze further, there are approximately 36 million people who are earning currently below the threshold. And even if they get a ridiculously high increase from their employers in this very depressed market, they will remain below the threshold. So essentially there are 36 million people who will not be impacted by the bracket creep consequences. And that is the electoral base of the government. So their quiet and creeping thing is for those who are of a higher earning bracket will definitely be affected. The majority of their voting base will not be affected because they are earning below the threshold and will remain below the threshold. So that was an election decision because VAT would have applied to everybody. This is going to apply to everybody notionally, but factually it won't.
Trying to look for some of the easier questions. With regards to third-party reporting and the fact that it's so close to us having to now do this for PBOs and local trusts, do you think SARS systems are geared to actually be able to handle those submissions?
SARS did have a pilot run. We're not sure what the results of the pilot run was. On many of the new computer things, SARS has battled with its implementation. But I think on this, they are going to want to make it work. So I think the pressure is going to be on us and for us to show that in reality, we do not have the capacity to do it, even if they do. I don't think we can turn the argument back to say they won't have the capacity to manage it, because I think they're going to have made sure that they have that capacity. They've issued the Gazette. They would have thrown resources at it, because for them, they believe it is exceptionally important for a pre-populated tax return. Their focus, unfortunately, on the tax return is all with pre-population, not with the stuff that's not on the tax return. So that misguided notion will come through with this.
So we're not anticipating the problems with 7C and donations tax that still remain outstanding?
I think for them, this is more important. But yes, Section 7C and donations tax, we've been asking since those sections were introduced, that they become part of the e-filing system and the e-paying system, and they aren't. I do accept that, but I think that their focus is more here than there, unfortunately.
Fair comment. So there's been a lot of talk about the 150 billion cash out from our gold and foreign currency contingency reserve. And for all the auditors out here, I know the word contingency starts to just bring back some terrible images. But do you think this 150 billion rand cash out in the next 3 years, what does that actually mean for us as a country?
It's a great worry. So when dividends were free of dividends tax, and in my youth, we found ways to take money out of a company from a non-distributable reserve and to declare that as a dividend. We no longer have non-distributable reserves in that sort of format in company law anymore and in accounting parlance anymore. But this reserve was that. It was a reserve that was never meant to be distributed. It was money that was never meant to be touched, because all it is a fluctuation in the rand-dollar rate. It's not real money. It's money that could reverse. If our Big Mac index worked and we came down to parity, that reserve would flow away. So we are taking money that might not actually be there away. And that is a great concern.
So basically, we're not actually selling any gold or foreign currency.
We're not selling gold or foreign currency. We're dipping in the differential in value. It's a worry. It's a grave worry. It's like they saw that last pot on the kitchen window with some money in it, and they said, let's do something with that pot. Hopefully, they're going to go slowly, and maybe the 29th of May might slow them down a little more.
Okay. It was also mentioned that the reason for drawing money out of this account was to reduce our extremely high debt levels, which was mentioned in the budget as being the cost of funding the debt at 20% of total expenditure. Do you think that this plan of theirs is going to work in actually bringing down any of that debt and subsidizing that cost?
Look, notionally, if we use the money to settle debt, it is a good thing. However, what we mustn't forget is we're taking capital, we're using it to settle debt that was created through salaries and wages. So we're doing something that no business ought to do. We're using long-term money and long-term debt to pay salaries and wages. We got it wrong from the very beginning. I guess one could try to argue that this is to try and fix some of that wrong. I just hope that they're not stealing too much from my children's children and their children by drawing out these reserves that should have remained.
So the next question was, does this have a long-term effect? But since it's affecting your children's children, I guess that was pretty much all that we had from the audience. Oh, sorry, there's one last question. The solar power incentive for individuals. So we did, I know you mentioned, go to a lot of effort with Parliament, with National Treasury and SARS to try and get it extended for a further year to make it more practical for people to actually do this, considering the law came out so late. But what was their reason for not extending it?
Well, they believe that people had known about it from the day of the budget speech and could have dealt with it. There was also a lot of pushback from the EFF that they wanted this rebate to be canned, both the business rebate. And so when they came to actually voting on the bill in committee, there was a lot of pressure. So I think they believe it's there. The incentive was given. It was known. The draft has been issued for some time. But I still don't believe it's enough, unfortunately. There wasn't enough publicity on the bill. There was not enough push on the actual act of installing it at home. And I think they also take a view that the rich have done it and the middle class doesn't have the money to do it, unfortunately.
Okay, thank you. I think that's all from our side.
Okay, so thank you very much for attending both the physical and the Zoom event. There will be a recording circulated to you after the event. There will be a question and answer quiz for you to complete in order to get a CPD certificate. I know many of you didn't come here to listen to me. You just came here for your CPD, and your CPD will be issued after you answer, I think it's 8 relatively simple questions. All the answers are in the slides, which will also be attached to the email. I thank you all, and I wish you well.